Hi everybody, welcome to our second video. Today we cover the second chapter of our lecture, and the topic for today is international parity conditions. Now, why is this an interesting topic? We all know that exchange rates fluctuate. So for example, the euro to dollar exchange rate today is different from the one year ago. And the question is why? Why do exchange rates change over time? And what are determinants, what are factors that drive those changes? It would be very nice to understand the factors that drive those changes, because then we might be able to predict exchange rate fluctuations. Would be very nice for us personally. Let's say in 1 year, when the pandemic is finally over, you're going to visit New York and you ask yourself, should I exchange my euros to dollars already today, or should I wait 1 year and exchange it then? If you would know how to predict the exchange rate, you could answer that question. So what we are going to do is we look at theoretical models that try to explain exchange rate levels and changes. And then we test these models, or we look at tests of those models empirically. Are those models actually able to predict changes and fluctuations in exchange rates? So the first model, you might have heard of this in an economics class, is called law of one price. So the main idea is simple. Basically, one product that is sold in two different countries should cost exactly the same. And this would mean that demand for goods in one country determines the demand of the currency of a country, and therefore the demand or the price of that currency, the exchange rate. And we can start with a simple example. Let's say there's only one good. There would be only one good that is traded in the world, and this good would be available in the US and in Europe or in Germany. And if there is only one good, then the exchange rate between euros and dollars could easily be determined by taking the euro price of that good and dividing it by the dollar price of that good. And then you would know exactly the exchange rate euro to dollar, because the good should cost exactly the same. Now you might ask, why does it need to cost exactly the same? What is the market mechanism that ensures that the price is the same in two different countries? So let's look at this idea. Let's say, okay, we have 1 euro being equally valuable as 1.2 US dollars. So the exchange rate euro to dollar is 1.2. This is actually the exchange rate today. I looked it up. And let's say there is a good that is sold in Germany and in the US. And I took the new Mercedes C-Class as an example. Let's say the product is launched in Germany and in the US. And let's say the prices are 45,000 euros here in Germany and 50,000 US dollars in the US. Now, our typical German guy might ask, okay, I would like to buy a Mercedes, but where can I buy it cheaper? And he might have an idea. So the idea would be, okay, I could buy it here in Germany for 45,000, but maybe it's smarter to take my money and exchange it to US dollars and buy it in the US. And basically, what you can see here, our German guy would only need 41,600 euros to exchange to 50,000 US dollars and then buy the Mercedes-Benz. Okay, now you might say, yeah, but why is this a market mechanism that ensures that exchange rates or prices are the same? Because our German guy would not be the only person doing this. He would tell all his friends, all his German friends, and everyone would take the same transaction. Now, this would lead to the following. First of all, the demand for US dollars goes up, because everyone wants to exchange euros to US dollars. So you go to a bank and you say, I want to buy US dollars and I want to pay in euro. So more and more people want to have US dollars. If the demand for something goes up, this means US dollars will get more expensive, more and more expensive. which means the exchange rate, euro to US dollars, will go down. Because you would get less US dollars for 1 euro if US dollars are more expensive. And you might ask, okay, how long will this go on? And I can tell you it will go on until 50,000 US dollars are exactly the same as 45,000 euros, until the exchange rate euro to US dollars is 1.11. So the logic here is demand for dollars goes up, price for dollars goes up, exchange rate goes down. I mean, this example is a bit simplified because there might be some transaction costs. You cannot just order the Mercedes online and they ship it for free to Germany, but without transaction costs, and that's what we are assuming here, this logic might work. So this is the idea behind the law of one price. Now let's get back to our slide here and let's check out how the law of one price works and what the implications are. And basically the implications are there is no real exchange rate risk. Exchange rates only fluctuate if prices for goods fluctuate. If basically the demand for a specific good changes. So there is no exchange risk that is independent from the price risk of a certain good. Now let's check out if the law of one price holds. There is a famous application of the law of one price, the so-called Big Mac Index. The Big Mac Index is conducted by The Economist, that's a financial newspaper or financial periodical or magazine. And the idea is, okay, McDonald's is available in almost each and every country. McDonald's sells the Big Mac in almost each and every country, and the Big Mac is more or less exactly the same. So we have the exact same good in many, many countries, and we can actually test the law of one price. Is the price of a Big Mac, if we convert it to US dollars, the same in all those countries? And for 2019, I used here some data for Germany and the US. The average price of a Big Mac in Germany was 3.99 euros. The average price for a Big Mac in the US was 5.74 US dollars. So, and the exchange rate, the average exchange rate over the whole year, 2019, so January 1st till December 31st, 2019, was 1 US dollar is 0.82 euros. And if we convert now the US dollar price to euro price, we will find that the 4.74 US dollars actually translate to 4.67 euros. And if we compare it to the euro price, we see the law of one price does not hold, because in Germany we paid 3.99 euro for a Big Mac. In the US, converted to euros, they paid 4.67 euros. So the US dollar is overvalued. The US dollar is overvalued compared to what we would predict if we only look at Big Mac prices. And you can actually check out the prices for 2021 by switching to our browser here. So I just Googled Big Mac Index and I found this statistic from Statista, and they took the data from The Economist. As I said, The Economist publishes the Big Mac Index regularly. And here we have data from January 2021. And what they do is they calculate the price of a Big Mac converted to US dollars in January. And you can see the most expensive is Switzerland. Here you would pay 7.29 US dollars for a Big Mac, whereas in the US the price of a Big Mac is 5.66 US dollars. In the Eurozone on average it's 5.16 US dollars, and so on and so forth. So you can see it is done for a whole battery of countries. It's a long list, and you can see the cheapest Big Mac you can find is in Lebanon, where you would only pay 1.77 US dollars. And remember, if the law of one price would hold, the price for the Big Mac would be exactly the same in all the countries. So there should be no difference between Lebanon and Switzerland if the law of one price would hold. So we can conclude that actually law of one price is a nice idea, but not applicable in real life to predict exchange rate changes. And why is that the case? So what are the limits of this theory? I mean, a model for just one good is maybe a nice didactical idea, but it's not applicable in theory. Because it might be that, or it's the case, it's the case that you have several goods and you would end up with several exchange rates. If you calculate the exchange rate based on the Big Mac, you might come to another conclusion compared to based on the new Mercedes C-Class. So the law of one price depends on the possibility to exploit the difference in prices. Might be true for a Mercedes-Benz, which you could order, or maybe a shirt, or maybe something else you could order online on Amazon. But for a Big Mac, it doesn't make too much sense if you find out, oh, the Big Mac in France, or France is not a good example since they have the euro, the Big Mac in Switzerland is very expensive. So the Swiss people would not start ordering Big Macs from Germany because it's not possible. By the time the Big Mac arrives, it would be cold and wouldn't be good anymore. So the concept is somehow only applicable to goods that can easily be traded between two countries. So we need an alternative concept. And the alternative idea is, okay, let's apply the law of one price, but let's apply it to a whole basket of goods. And this is called the absolute purchasing power parity, PPP. So absolute purchasing power parity has exactly the same idea as the law of one price. The only thing that is different is we now look at a whole basket of goods. In Germany, we have the consumer price index. In German, we call it Verbraucherpreisindex. And the consumer price index tells us how much does a basket of representative goods cost. And representative means a basket that includes all the products and services we need in our daily life in, let's say, the average proportion. So in this basket there is some food, some groceries. In this basket there is cost for energy, cost for housing. In this basket there are some services like haircuts. In this basket there are clothes, there are electronics like a laptop, a camera, TV. All goods we need in our daily life are in this basket, and then the overall price of the basket is calculated. And the idea now is, okay, maybe the price of this representative basket here in Germany is similar to the price of a representative basket in the US. So our exchange rate should be price of basket in euro divided by price of basket in US dollars. That's the formula we have here. So exactly same idea as the law of one price, but for a basket of goods. Why should the purchasing power parity, the absolute one, hold? So what is the idea? I mean, we can start by a situation where it does not hold. So let's say the basket is more expensive in Germany than in the US. So this is the equation here in the first bullet point. Price in euro is more expensive than the US dollar price if we convert it to euro. Okay, what would happen? There would be the tendency to export goods from the US to Germany. We as Germans, we would import those goods because they are cheaper over there than they are over here. I mean, we have this phenomena with China and other low-cost countries. If you think about AliExpress or something like that, some people order their products there because they are way, way cheaper compared to buying them here in Germany. So, okay, we would import goods from the US, and the US manufacturers would export them to Germany. Okay, what would happen? First, supply of goods in the US goes down because, we are buying their products, so they have less products, so supply goes down. What happens if supply goes down and demand stays the same? The good becomes more and more rare and the price goes up. So this is the first thing we would experience here. I use these colors so you can see which sentence belongs to which effect. So price for the goods in the US goes up. Simultaneously, because a lot of people are importing goods from the US and have to pay them in US dollars, the demand for US dollars also goes up. I need dollars to pay my Amazon invoice from the US. So if the demand for something goes up, the price goes up. So we have exchange rate in this sense going up, that US dollars become more expensive. Okay, and then higher supply of goods in Germany, since we have our own goods that no one buys, and we have the goods we import from the US, we have more and more goods. So the supply goes up, demand is more or less the same, so the good is not that special anymore, meaning the price goes down. And you can see all those effects would lead to an overall effect that the left side of this equation, price for the basket in Europe, moves closer to the price of the basket in the US. So these effects would go on as long as there is an unequal sign here or a larger sign, and it would stop if we have an equal sign. So the effects would cause the price of the Euro basket being equal to the price of the US basket. And that's why it makes sense from a theoretical perspective to assume that the absolute purchasing power parity would hold. Now, there might be some drawbacks. And one of the drawbacks is the consumption basket might not necessarily be exactly the same. Maybe in the US basket, there are some goods we don't have in our basket. I guess you can think of an easy example. We don't buy guns. The US people, they buy guns. They spend their money on guns and rifles. So in the basket, a small fraction will be guns, will not be in our basket. And maybe there are other goods that are in our basket that are not in the basket of the citizens of the US. In addition, there are some non-tradable goods that cannot be traded no matter how open and how globalized the world is, like haircuts. So you cannot, just because the haircut is cheaper in the US, fly over there and get a haircut. It will be, the transaction cost will eat up all the savings by from this cheaper haircut. So the law of one price might be violated because of some market frictions, transaction costs, and so on and so forth. But overall, this idea is actually quite good and might help us to understand why exchange rates fluctuate. Okay, the last one. So let's say, okay, we acknowledge that there are some problems with the absolute purchasing power parity. Maybe there's a better way to explain it. And the idea now is the relative purchasing power parity. And this is more confusing and more complicated. So let's go through it step by step and think about why this might make sense. So the purchasing power needs not to be exactly the same in different countries, because we know we have different baskets and so on and so forth. But the purchasing power ratio, so the real exchange rate, the changes in purchasing power, should be constant over time. What does it mean? We have this pink box here where we have a formula. So the formula says the exchange rate from euro to dollar next year, so let's say t+1 is next year, or could be next day, next minute, next second, whatever. So next period divided by today's exchange rate. So basically what we have here is the change. Let's say tomorrow the exchange rate is 1.2, today it's 1.0, then this left part of the equation would be 1.2. It changes by 20%. And we should be able to explain this change by looking at the change in prices of these representative baskets. So it says, the idea here is the relationship between the change in the price of the euro basket compared to the change in the price of the US basket, that's the right side of the equation. We have a double fraction here. The nominator of the big fraction is the change in the price of the euro basket, and the denominator in the big fraction is the change of the price of the US basket. So this change should be similar to the change in exchange rates. So that's an alternative version of the purchasing power parity. It's the relative purchasing power parity, and it recognizes that there might be different levels of purchasing power in different countries, but changes should be explained by changes in the price of these representative baskets. Okay, I understand that this is a bit more complex, but the idea, I guess, is somehow straightforward. So how are those concepts related? The strongest concept with the strongest assumptions is the law of one price. It says every single product has to have the exact same price in each and every country. The Big Mac has to cost the exact same in Lebanon, Switzerland, US and Germany. And not only the Big Mac, but also the Mercedes-Benz and the haircut and your new Nike sneakers and so on and so forth. So law of one price is very strict, which means if the law of one price holds, so the strictest rule holds, then also the absolute purchasing power parity holds. Because if the price of every product is the same, then the price of the basket has to be the same. It follows from the law of one price. So the absolute purchasing power parity is also strict, but not as strict as the law of one price. And the weakest form, so to say, is the relative purchasing power parity. Relative purchasing power parity holds if absolute purchasing power parity holds, because if the absolute prices are the same, then clearly the relative prices are the same. But in the opposite direction, it doesn't work. The weakest form, relative purchasing power parity, does not mean that also absolute purchasing power parity holds, and does not mean that law of one price holds. So you can go from law of one price to relative purchasing power parity, but not backwards. Because from the strongest, the second strongest follows, and the weakest follows, but from the weakest, the second strongest does not follow, and also the strongest does not follow. All right, as I promised, we look at some empirical evidence for those theories. We already know law of one price is violated. We have seen the Big Mac index here from 2021. We have seen the Big Mac index over the whole time period of 2019. Prices were different. And other studies, there are a lot, find the same result for different goods like wallpaper, soap, car tires, furniture, cement, chewing gum, cigarettes, beer, golf balls, whatever. All those products have different prices in different countries. And you can see within this list here, they actually focused on products that are easily tradable. I could easily ship some cigarettes from the US to Germany. I could easily ship some golf balls from Germany to Switzerland. And still, the prices are different. Okay, law of one price does not hold. What about the absolute purchasing power parity? Some evidence is there that it holds, but only in the very, very long run. So decades or centuries. It means that studies show that the purchasing power decreases more strongly in countries with higher purchasing power. Basically, you have some countries with high purchasing power. Switzerland, for example. There everything is expensive, but people even earn more money so that they can afford more things compared to the average German. So Switzerland is a country with very high purchasing power. Germany has lower purchasing power. And studies show that the purchasing power in countries like Switzerland goes down. And actually, at some point in time, it matches the purchasing power of the countries surrounding that country. But it takes very long, and then you might have some different effects, some different shocks, which brings this balance to an imbalance again, and then it takes very long again to get it back in some balance or equilibrium. So some evidence is there, but only in the very long run, so it's not important for us. We cannot predict the fluctuation of the euro US dollar using this theory. We might say maybe in 100 years, the exchange rate between euro and Swiss francs goes down. But okay, that's nothing we really care about. And the relative purchasing power parity, studies find again a weak impact on exchange rates, also rather long term. So still not a good theory to predict fluctuations in exchange rates on a day-to-day basis, which might be necessary if you are a multinational corporation and you have some day-to-day business with different countries. So that's a little bit sad, because the conclusion is real exchange rate risk exists. So there is some risk that exchange rates change that we cannot explain with changes in prices. So purchasing power parity is not suitable to predict those changes. And we need different mechanisms, we need different products, financial products, to manage those exchange rate risks. And this graph, you know it already from our last lecture, might help to understand why purchasing power parity is not well suited to explain these fluctuations. You can see that the proportion of traded in goods, which would mean trade in goods influences the exchange rate, is so small compared to trade in currencies that there needs to be some other effect in place, some other thing in place that drives the exchange rate risk and the exchange rate fluctuation. Okay, with that we are closing the first part of this lecture. We have to admit there's no very good theory to predict fluctuations in exchange rate markets. I actually looked at some research papers because I thought maybe, you know, there are newer or different ways, techniques based on big data, data analysts, to predict how exchange rates will move. Background is I was working in Switzerland before I joined the university, and I got my salary in Swiss francs, but I was living here in Germany, and I always ask myself, is it better to exchange it to euros every month? Is it better to wait until, you know, a lot of money has piled up and exchange it then? And the idea was maybe I can somehow predict how exchange rates move. If they move in a way that is good for me, where I get more euros for my Swiss francs, I would maybe wait. If they move in a way that's bad for me, I would exchange it immediately. But it turns out there are no ways to have a very precise or a very good estimate in which direction the exchange rate goes. So it's pure luck. We shouldn't try to speculate with exchange rate. We cannot really forecast it. Okay, and with that, we close this forecasting and theory section, and we move. Here I have a graph, sorry, that is just how it fluctuates, and we move to some definitions. So there is something we need to do about the risk of changing exchange rates. And one thing we can do is we can go to a bank and tell them, hey, it might be that I need to exchange euros to US dollars in 1 year because I'm visiting New York. And I don't know how the exchange rate will be in 1 year. And I'm afraid that it moves strongly in a direction that is bad for me. And the bank might say, okay, that's no problem. You have two options. First option is you give me the amount of money you want to exchange today, and I give you today's exchange rate. And you might say, the idea is good, but I don't have the money today because my vacation starts in 1 year, and I'm going to save up some money each month. And then in 1 year, I have the money I need to go on vacation. And the bank might say, okay, then we have another product for you. You can enter a forward contract. So the forward contract means you tell the bank, hey, I'll be back in 1 year, and then I'm going to exchange 2,000 euros to US dollars. And the bank says, okay, I guarantee you an exchange rate. We already make a contract and we put in the exchange rate that you will get in 1 year. Independent of what the exchange rate in 1 year will actually be, you can fix it today. So you have no risk, you have certainty about the exchange rate in 1 year. And that's the definition of a forward contract. So we have here a forward rate is the exchange rate at which a bank agrees to exchange one currency for another at a future date. Not today, but at a future date. And the payment is also made in the future. You don't have to pay today. You can save up your money and then exchange it in 1 year. And the euro-dollar forward rate is called F. So the spot rate, we use S for spot rate. The forward rate, we use F for forward rate, euro to dollar. Okay, here's an example. A similar example I made with our vacation, but with Tokyo and not New York. You can go through it and check out if everything I just told you makes sense and if you can understand this example. Now, there might be not only a difference in purchasing power in different countries, there might also be a difference in interest rates. You know that in Germany today, if you go to the bank, you get more or less 0% interest on your wealth. You can bring 10,000 euros to Volksbank Esslingen and they say, okay, we can keep it, but you don't get any interest. If you go to another country, maybe Lebanon or Greece, it might be different. It might be that in Lebanon or Switzerland, the bank says, okay, here you get 1% or 2%, whatever. Any number different from 0. And the question is there some relation between the interest rate in different countries and the exchange rate of money? So maybe, because interest rate is the price of money or the price for money in a specific country. So what does it cost to buy 10,000 euros at Volksbank Esslingen, to borrow it for a year? It costs 5% interest. What does it cost to borrow, I don't know, 10,000 US dollars at your local bank in New York? Maybe 3%. So the price of money is the interest rate. And the question is, the local prices of money, do they have an influence on the exchange rate between two currencies? And the idea is the following. We will look at a second example here. So we had our car example here. Let's move to a money example. And let's take US dollars and Japanese yen. So let's say we have two banks, one in the US, one in Japan, in Tokyo and New York. And you go on their website and you see the following offer. The interest rate for 6 months, let's say you bring your money to the bank for 6 months, is 4%. Or if you borrow money for 6 months, it's also 4%. 4% interest. In Japan, interest rate levels are lower. Interest rate is only 2% for 6 months. And let's say the exchange rate from US dollars to Japanese yen today is 1 US dollar buys 106 Japanese yen. And you ask the banks, hey, what's the forward rate? If I would want to exchange some US dollars to Japanese yen or some Japanese yen to US dollars in 6 months, not today, but in 6 months, how much would I get? And the banks tell you the forward rate, we just look at the forward market, is 103.5 Japanese yen per US dollar. So Japanese yen is expected to become a bit more expensive. Today you get 106 Japanese yen for 1 US dollar. In 6 months, you only get 103.5. And before we were looking at our average German guy who wants to buy a car. Now let's look at our average American investor who might ask himself, what can I do here? Can I somehow make a profit based on this situation? And he might say, oh yeah, I have a great idea. I go to my American bank and I borrow $1 million at 4%. So let's say this guy here is a trader for an international investment bank, then it's easy to borrow $1 million. As a private person, might be more difficult. Could also be someone working for Siemens or for Adidas, for Daimler in treasury. Big company can easily borrow 1 million at 4%. Simultaneously, our guy here says, I also enter the forward contract. I also want to secure the exchange rate in 6 months. So let's exchange some Japanese yen to US dollars in 6 months, and I secure the exchange rate of 1 to 103.5. Okay, now I have 1 million US dollars and I know I can exchange Japanese yen to US dollars or vice versa in 6 months. So what do? Okay, I take my 1 million and I exchange it today, immediately, based on the spot rate, which we have on top of this slide here, to 106 million Japanese yen. $1 is 106 Japanese yen, $1 million, 106 million Japanese yen. Okay, so now I'm sitting on 106 million Japanese yen. I go to the Japanese bank and say, hey, I want to invest 106 million Japanese yen for 6 months. And they say, okay, you get 2% interest. All right, so I invest at 2%. I receive 106 times 1 plus 2%, 108,120,000 Japanese yen. So 6 months later, I have now 108,120,000 Japanese yen. And I remember, okay, I entered this forward contract, so I can change it back now to US dollars, and I already know what I will get. I will get $1 US for every 103.5 Japanese yen. So I change it back. And I now have 1,044,638 US dollars. And you ask yourself, is that a good idea? Is our guy here smart? And the answer is yes, because the situation is now the following. You now have 1,044,638 US dollars. You have to pay back the loan because you borrowed 1 million at 4%. So you have to pay back 1,040,000, which means you made a profit of 4,638 US dollars. And you might say, okay, for a company or an investment bank, is this a lot? Maybe not, but I mean, you can repeat and repeat and repeat and get rich. So this is how interest rate arbitrage would work. And the effect would be, if the forward rate is 103.5, that a lot of people try to do this. And the demand for Japanese yen goes up, the demand for forward goes up, and because the demand changes, the price will change, and the price will change to a level where this kind of transaction is not profitable anymore, where you end with the same amount that you would owe the US bank and your profit would be zero. That would be, again, when markets are in balance. Okay, so the question is, how can we calculate this level of interest rate parity? So we know interest rate parity is a thing, and here is an example how we can derive the formula for the fair forward rate, the forward rate that does not allow for arbitrage. So let's say the interest rate in Germany is I euro. For a euro investment, we get an interest rate of I. We use I for interest rate, I interest as short. The interest rate in the US is I dollar. And the exchange rate, we have a spot rate. That's the exchange rate for which we can exchange euros and dollars today. And we have a forward rate or a future rate for exchanging $1 to euro in 1 year. Okay, we have two options. We can say, let's invest at home. Let's just take the 100, give it to the bank. 1 year later, we have 100 times 1 plus interest rate. So this is the cash flow statement here on the bottom left. We have today and in 1 year, these are 2 points in time. Today we have minus 100, we give the 100 to the bank. And 1 year later, we receive 100 times 1 plus whatever interest rate we get. Okay, the second option is, all right, let's invest in the US. So today, first thing we do is we exchange 100 euros to US dollars. How many US dollars do we get? 100 times the exchange rate, 100 times S dollar euro. Okay, now we have some dollar amount. We bring it to the US bank, so we invest it. We have minus 100 times whatever exchange rate we received. And we have no money in our bank account today because we gave it, we have it in the bank account. We don't have it in our pocket. It's invested at the bank. And then 1 year later, the bank pays us back our investment, which is 100 times interest rate, times exchange rate, times 1 plus the interest rate for US dollars. So 100 times spot rate dollar euro times 1 plus I dollar. So this is the third line here in this cash flow statement on the bottom right. And now we exchange it back, and we exchange it back based on the forward rate we already agreed on when we started our transaction. So the euro amount we now have is 100 times the spot rate from T0. This is the amount we got in dollars. Then we brought it to the bank. It grew by 1 plus interest rate dollar. And now we multiply it by the forward rate, by the forward euro dollar rate we agreed on when we started this transaction. And our rule is, or our condition is, both investments must have the same value to us, because otherwise there would be an option for arbitrage, in the sense we just saw with our American Dad example. Okay, if these two options have to have the same value, this means we know from the previous slide that this amount of money here, this is what we get with our euro investment in Germany, and this amount of money, this is what we get with our investment in the US and entering in the forward agreement, has to be exactly the same. So we have a formula now that we can solve for the forward rate. So this simplifies to forward rate dollar euro is spot rate dollar euro times 1 times, and then a fraction, 1 plus dollar interest rate divided by 1 plus euro interest rate. Here the formula in the pink box. And the cool thing about this is, you might say, okay, that looks super complicated, but you can look up everything today that you need to calculate the forward rate. The spot rate, just Google euro dollar interest rate, 1.19 today. You can check out what is the interest you would get at Volksbank Esslingen, and you can check out what is the interest rate at JP Morgan Chase for investing, 100,000 euros, 500,000, 1,000, 1 euro, whatever. And you have all the information you need to calculate the forward rate. And if the forward rate that someone offers you is different from what you just calculated, then you can make an arbitrage profit. So finding these arbitrage opportunities is not that difficult, because all the information you need is basically readily available every point in time. And that's why a lot of traders do this, and that's why on average the arbitrage opportunities go away and the market is very efficient. Okay, so now we know the relation between interest rates and exchange rates, and especially between forward rates and interest rates. The covered interest rate arbitrage example I just showed in the animated slides is also here on slide 17 in your files. Since the animated slides, I didn't put it in the slide deck. So here you have it. I copied it actually from our textbook. This is an example directly from the textbook. You can see I just screenshotted it from the PDF. And here you have the data and the same assumptions as we just used in the animated slide, but you can go through it step by step at home if you need some more background and if you want to practice that. So that's covered interest rate arbitrage. The question is, why is it called covered interest rate arbitrage? And you already see it here. I circled it with a red circle. It's called covered because you already know when you start what the exchange rate in the future will be because you enter into the forward contract. So you cover your position. You have no risk basically. You know the interest rate at the Japanese bank, you know the interest rate at the US bank, and you know the forward rate, so you know exactly how much you have to pay in Japanese yen to transfer to US dollars. So there is basically no risk, and that's why it's called covered. All the risk is covered. Covered interest rate arbitrage. Also, in short, CIA. And there's something else, it's called UIA, uncovered interest rate arbitrage, and you can see if I swap here, the difference is, and that's the only difference, the uncovered interest rate arbitrage, you do the same steps, but you do not enter into a forward contract. The only thing you do is you say, okay, I start in this example, it starts with Japanese yen, 10 million Japanese yen. You start with 10 million Japanese yen, you convert it to US dollars based on today's spot rate, but you don't enter into a forward rate. So you take the risk, you say, okay, I expect the exchange rate to move into a direction that is good for me, and I'm just taking the risk and I just try to make this transaction. So you take the 10 million Japanese yen, you convert it to US dollars, you invest it at the US bank, in this example here at 5%, you get back some US dollars, in this example 87,500, and now you go to the market and you say, I have 80,500 US dollars, I want to transfer them to Japanese yen, and you ask, okay, what is the price today? So you have a huge risk because over this time period, in this case, we picked a time period of 1 year, or EMS picked a time period of 1 year. This is also from the textbook. In this 1 year, the exchange rate can go up, down, whatever. And 1 year later, you realize, oh, I speculated and the exchange rate moved in a direction that was not good for me. I lost a lot of money. Or the exchange rate moved in a direction that was very good for me and I made a lot of money. And in this example, the spot rate, the expected spot rate, the spot rate that our trader thinks will be in place in 1 year is $1 equals 120 Japanese yen. And so basically he just thinks the spot rate does not change at all, because spot rate at the start was 120 Japanese yen is $1, and he expects, or she expects, it to be 120 in 1 year. And based on that, the investor would have made some profit. In this case, 460,000 Japanese yen. But the problem is, it's just an expected spot rate. It's uncovered because no forward is used, only the expectation. So it's very, very risky, and this is based on currency risk. The risk is basically currency risk. All right. So I show you both of those transactions. This here is real arbitrage in the sense that you can make a riskless profit. This here is arbitrage, quote unquote, because it's not risk-free. You take on some risk. And I want to close this session with a last slide where we look at some empirical evidence whether or not uncovered or covered interest rate arbitrage is actually possible in real markets. And studies show that the uncovered interest rate parity does not really hold, which means that the uncovered interest rate arbitrage is possible, that you can build, you have some tools to build an expectation about the development of exchange rates or in the future that allow for uncovered interest rate arbitrage. So what we observe in the market is that investors, big investors, hedge funds, investment banks, traders, borrow money in low-cost countries where the interest rate is low and invest in high interest rate countries. And normally, if all the parity would hold, this shouldn't make any profit. In our animated slide, the profit should be zero if a lot of people do it. But empirically, it is found it is actually possible, not for you, not for me, because we face high transaction costs and we don't have the funds needed to pull that off, because often you make like 3,000-4,000 euros per 1 million euro invested. So if we have 1,000 euros, we make 30 cents and it's not worth the effort. So you need a big investor, but those big investors, hedge funds, investment banks, and so on, follow sometimes that strategy. And such a strategy or such a position, maybe you read about it in a financial newspaper or The Economist, Wall Street Journal, that's called a carry trade. Okay, and with that, we're going to close the session. The reading list, in case you want to read up on this topic, you want to take a look on how EMS explain the covered and uncovered interest rate arbitrage, you can check out chapter 6 of our textbook. And with that, we are done. We see each other then in the next live session or in the next video session. Take care. Bye.